Just wanted to run through a quick traditional syndication deal. So a lot of stuff we've been doing and putting on the Facebook group has been a cash out refi after 2 years. So we also look at like a 5-year hold if it's a really good market. So I just wanted to run through quickly how we would look at that and what calculator we would use and kind of the assumptions we would make based on a traditional hold. So here's the property. This is in Atlantic, Georgia. It is a 157 units. It's on market. They don't have an asking price, so I will go through that. Let's see here. Put this on float. Okay, so here I already did some basic assumptions. So it is 157 units. It's a studio, or they have 2 studios, 154, 2-bedroom, 2-bath, and 1 4-bedroom, 2-bath. These are the current rents, averaging out to $876. And then market rents that I looked at are averaging out to about $938. So this is our traditional syndication calculator. I'm just going to assume that we're going to put an offer in at about 10 million. Might be, more than that after we look at it. Might be less. So this is Atlantic, Georgia. This is a great market. A lot of people are moving here. A lot of businesses are moving here. This is a market that you would feel comfortable doing a traditional syndication in, just because in 5 years you'd be confident that you could sell this property and that the market had gotten better. So let's go through some basic assumptions. Cap rate, this is a sale cap rate. So this would be, you could talk to your mortgage broker, kind of get their opinion in 5 years where the market would be, where you would make the sale at what cap rate. You can be conservative and use like a half point higher. I'd say that's pretty conservative just in case there is a downswing or the economy changes and you can't sell it at that lower cap rate that you were projecting. So rents, so like I said, I already did that. So 876 would be year 1. And then year 2, after we do repairs and get our raise the rents, 938. So rent growth, this is a great market. So I would say 3% would be a good rent growth. 157 units. This is 90% occupied, I believe. So I would say 25% down payment would be achievable. You might be able to get 20% down, but just be conservative and use 25%. So your down payment would be about 2.5 million on a 10 million purchase. So the mortgage 7.5 million. Interest rates are pretty low right now. Use maybe 3.75 on a stabilized property like this. Amortization 30 years. So your monthly payment 34,000, annual payment 416,000. There's no owner carry, no second mortgage, so we'll skip that. Closing cost, typically use 3% here. That covers your PPM, all your closing, all the fees and orientation fees for the loan, everything like that. And this is for traditional syndication. You're going to bring in investors, so you're going to have a little bit higher closing cost than like a 5-unit property that you were just buying yourself. So 3% is a good number to use. The acquisition fee, this is 3% as well. So this is where you pay yourself for actually doing the deal, finding the deal, raising the capital, doing everything for the deal. So also, I wouldn't forget that you do probably have to pay a broker, most likely, and they probably want 1%, 1.5%, maybe 2%. So you can just raise this to include the broker. I'll keep it at 3% for now. Repairs, this is, like I said, a stabilized property. It looks like it's in pretty good shape. Might be some repairs. It's used about $2,000 a unit. Reserves, you're going to want to talk to a mortgage broker again, see what kind of reserves you'll need to get the loan. Just use $500 per unit for this. So 3.4 million is the total money you will need to raise to close this deal. So this is kind of like a snapshot of year 1. So gross potential income 1.6, that is 876 times 157. So so monthly market rate 876. 10% vacancy, effective income 1.4. Right now they're operating at about 45% expense ratio, so that's 668,000. So stabilized, let's say we lower the vacancy down to 6%, 1.7. It's based on our 938. New rents, vacancy 106,000. So expenses 747,000. Seems a bit high, just because right now they're operating at 668,000. So I mean, you could maybe lower this, but if you want to be conservative, you can keep it at 45%. You could also lower this down to be a little bit higher than this, because a lot of these expenses are most likely fixed costs. So debt service is going to stay the same. So your cash flow has went up about 100,000 after making the repairs, and your NOIs went up. So this is the P&L down here. So it's pretty much the same exact thing. It's right there for the first 2 years, and then the rent growth is from our 3% rent growth here. So rent growth continues each year for 3%. So down here, this is what we have, a 70-30 split. This is the investor structure. So 70% goes to the investors, and then 30% goes to the members, the GP, the general partners. So there's limited partners and general partners. The limited partners are the investors that you raise the money from, and the GP is the people actually sponsoring the deal and doing all the work. So 70-30. So after the debt service, you have 400,000 available for distribution. So you'll split that 70% and 30%. So total distribution to the members, 280,000. And remember, we had to raise 3.4 million. So they get back 280,000 the first year. So it's an 8% cash on cash return for year one. Year two, after we raise the rents, increase the NOI, start with our own asset management, we can maybe even lower expenses more. Now we're at 10% cash on cash for the year, and the average is 9.32. And so this is a 5-year hold. So up here I set it for 5 years. We're going to sell it in 5 years. So you don't really want to do a refinance typically on a stabilized deal. You're not going to get a lot of your capital back, and the refinance loan is going to be very similar to the acquisition loan. So you just end up paying a lot of fees for no reason. So there's no refinance on this one. It's just a sale in 5 years. So let's see down here, sale 5 years. It would take the NOI $1,034,000. Our sale cap rate 6%. So the sale price would be $17 million. Sale cost, this is 4.5% of the sale price. So outstanding balance, you have to pay off the loan. So that's the total equity created from start to finish. So you have to return the capital and the profit from sale. That's what's left. Okay, so then that gets split to the members and then the managers. So you would take the return of capital and you would add that with the profit to the members. So 7 million, this is how you get your IRR down here. We had to raise 3.4 million. The cash flow each year comes in here. So this goes over here. They all get added up, and then this is the sale year, 7.8. So in total, in a 5-year hold, you sell this property and you make $6 million. It is a 25% IRR to the members, to our investors. So this does not include the manager's profit. So this is just for the members. So cap rate at purchase, these are all your returns here, would be 8.17. So this is probably going to be low. They're probably going to be asking for a higher number on this, just because it's Atlanta, Georgia. They'll probably try to sell it at like a 5 cap. So right now, though, with this number, our cap rate at purchase is 8.17. Cash on cash year one, 11%. Debt service, 1.96. So the debt service is your NOI divided by your actual total annual debt service. So you want this to be above 1.25. So basically, if your NOI was the same as your debt service, it would be 1. So that's why you want it a little bit higher. So cash flow year one is 400,000. Investor returns, this is for the entire 5-year hold. So if we did like a 10-year hold, change this. I have to fix that. But so investor returns would be 8.68, average cash on cash 10%, IRR 25%. And we didn't do a refi, so there's no refi return capital. You can change this up as well. If it's a really good deal, you can give less equity or more equity. You can do 20%, 80%, and then a 10% preferred, or just however you want to structure your deals. But yeah, like I said, this is kind of just like a quick run through of what we would do for a traditional syndication. So I'm sure I left a lot of stuff out that I can go over later. If you have any questions, just leave a comment below. But But yeah, we would only really do this if it's a really good market, and it's something that we were confident the market would continue to grow. The population's growing. Um, just the employers. There's a lot of employers. It's not one thing could just mess up the market. Obviously there could be a downturn, so you want to be conservative. But if you're in like a second tier market, it's going to be pretty hard to raise the capital, and then also you're going to be a little less confident on that sale at year 5. You have to find someone to buy the property. So if you're in Atlanta, Georgia, if you're in Houston, Dallas, Fort Worth, if you're in Raleigh or Charlotte, you're very confident in 5 years someone's going to buy that property from you. So that's why we would only do a traditional syndication in those really good markets. So this is just a quick analysis. I'm sure we'll be doing more of these quick analyses on some traditional stuff, since we are looking at a few traditional properties right now, and we'll go from there. But like I said, if you have any questions, just leave a comment below, and I'll be happy to answer them. Thanks.